Bloomberg Audio Studios. Podcasts, radio, news.
Single best idea. And the single best idea is we understand it's a grind. We do economics, finance, investment, and international relations. There's high points, there's big interviews and all that. But part of it is just going from conversation to conversation with the many different opinions about where the market's going. We pay a little attention to who gets things right, but we really pay attention and study who got things wrong. It's something we're constantly dealing with. And today was just an absolutely vintage day of different opinions. Anastasia Amorosa with us from Partners Group, many others. Mike Wilson stopped by from Morgan Stanley. He was a piñata 2 years ago on should you be in the market, not be in the market. He sees a new bull market. Here, Wilson of Morgan Stanley.
As usual, the markets get ahead of this. And what the markets are anticipating now, the bond market and the equity market, that the Fed will be cutting sometime in the next, 2 to 6 months. And, even our house call is for no cuts this year, but then they have 7 cuts next year. That's like wildly bullish for equities. Okay. So, it's you almost have the perfect setup, Tom, because what you have now is lagging economic data, which is what the Fed uses to make decisions. And you already have the equity market and earnings revisions telling you what's going to happen. So, they're looking backwards and they're going to be looking at lagging labor data, and then of course lagging inflation data, which should come down ultimately later this year, next year, and they're going to cut into that. But there's not going to be a knock-on negative effect for earnings revisions in the way that people kind of assume when you get that sort of decline in labor data. In fact, I would argue, because it's gradual, that we're going to see revisions go up because, when companies reduce headcount, it actually accrues to margins.
Mike Wilson there of Morgan Stanley. That's a very important observation. Have we even framed out the caution that we'll see in September 30 ending quarter, Q3, and as we go to the beginning of the year's earnings season, call it, October 16th, 17th, 18th, and tech earnings October 30, whatever those dates are. It's just fascinating to see if we get the reticence again, no growth, low single-digit growth, mid-single-digit growth. Oops. Once again, a better than good quarter. Joining us, Darrell Cronk from Wells Fargo. He's really good at historic perspective. Just can't say enough about the joy, the density of his excellence. Here's Darrell Cronk of Wells Fargo.
I am elated about earnings, right? So we've been waiting through 23, 24 for earnings to catch up with multiple expansion. Remember and recall, first quarter earnings, S&P, 7% revenue growth, 15% earnings. This morning, we're tracking 6% revenue growth, 10% earnings, right? I will take that all day long, right? The margins are still holding up, so you're not seeing the erosion in margin deterioration that everybody was concerned about with higher prices and the pass-through effects yet of tariffs. Maybe they come in the back half of the year. Where we would stay away from, we have just been bearish on small caps for a long time. It's interesting, if you go back 3 years from right now, and I invested in a money market fund at 4%, I outperformed small caps over the last 3 years.
Darrell Cronk, that's an important observation there, just on money market. We heard that from Russ Kosterich today and Matt Brill as well. This idea of get the coupon, get some total return. The low yield days are over, and the total return, the risk-adjusted total return, rather, in bonds is something to study. To study as well on our podcasts across the nation, on Apple Podcasts and Spotify. Joe Weisenthal, Tracy Alloway, #1 for Apple Podcast yesterday off their magnificent New York Times article. That's Odd Lots. We're on YouTube Podcasts. It's Single Best Idea.